We can now begin.
Good morning, good afternoon, everyone. My name is Lee Buchheit. Let me welcome you to this presentation on the review of the IMF's sovereign arrears policy. I have been asked to give you a very brief introduction to the policy and then turn it over to the people who are really the masters of this subject. So, in a nutshell, here is the nut. The International Monetary Fund lends into situations of sovereign distress. In other words, it lends at precisely the moment that every right-thinking creditor is trying to exit. That is the fund's mission. But it obviously involves acute risks to the fund. It is lending into situations where the member country may not have yet resolved its debt difficulties with its existing group of creditors. Therefore, quite understandably, the fund wants to see the member resolve its problems with existing creditors, whether bilateral or commercial, normally in the form of a debt restructuring, before it opens a program for that member, or at the very least, shortly thereafter. That policy, however, has its own risk. If a creditor, commercial or bilateral, understands that policy, the creditor can leverage the debtor country by saying that they will refuse to accept a debt restructuring of their existing exposure until the debtor country accedes to whatever it is the lender wants, and by refusing to do so, theoretically, can block the fund from opening a program. In the late 1980s, the fund attempted to neutralize the leverage that a commercial creditor could have in that way by articulating a policy in which the fund said it would be prepared to lend into a situation in which a commercial creditor's existing loans have not yet been resolved. In other words, lend into the arrears of the debtor country to that creditor under certain conditions. That was the lending into arrears policy. In this century, the fund has also had to confront a situation in which, or situations in which, official bilateral creditors have attempted to use the leverage of refusing to restructure existing exposure as a way of potentially blocking a new fund program. Under the genus lending into arrears policy, therefore, we now have two species: lending into private sector arrears and lending into official sector arrears. To discuss both the evolution and the refinement of these policies, we begin with an exceptionally distinguished panel of IMF staffers. Wolfgang Burgthaler is an assistant general counsel in the fund's legal department. Tom Best is an economist, now serving in the fund's strategy, policy, and review department. Julianne Ames is senior counsel in the legal department of the IMF, and Thor Jonasson is the deputy division chief in the monetary, capital, and markets department. I am now going to turn the podium over to Wolfgang and let him continue with the panel. Thank you.
Good morning, good afternoon, good evening, everybody. Many thanks, Lee, for the kind introduction. As you can see from the next slide, the review that Lee described covered 5 areas: the lending into arrears that Lee just prescribed, the policy for preemptive debt restructuring, the lending into official arrears, and the non-toleration of arrears policy, and lastly, defining the perimeter issue between official and private claims. The IMF reviewed these policies to better support orderly and transparent resolution of sovereign debt difficulties in the light of the evolution of the creditor landscape and instruments of the last couple of years. This review brings to closure a process of about 2 years of consultation with many official and private stakeholders. I would also like to acknowledge that this work was the work of an interdisciplinary team, the team that you're seeing today, from IMF staff from different departments, and a close collaboration with IMF departments, other departments, and also IMF management and the IMF executive board. Finally, I would also like to flag that the paper brings together in one place related IMF policies on debt sustainability, financing assurances, and market access. These policies, however, were not part of the review. We also prepared a supplement in the paper that you will see the link to that consolidates all the various policies into one consolidated arrears policy document. So this paper is really a one-stop shop. Next slide, please. So it's useful to step back. What is really the purpose of these IMF's arrears policies? I think Lee already described it very nicely. We are focusing on cases where sovereign debt restructurings are required, which is generally the case when there are arrears. However, this is a minority of the cases when members use the IMF's resources. And the IMF is striking a delicate balance. I think Lee already described this balance. On the one hand, under the articles, the IMF can only lend to solve members' balance of payments problems in support of an IMF-supported program to return the member to medium-term external viability. The IMF also requires that lending only occurs under adequate safeguards, given that our financing is temporary and needs to be repaired. In order to do that, debt must be sustainable, which requires normalized debtor-creditor relations. Therefore, the policies must ensure we have a level of assurances. Basically, the IMF needs assurances that the restructure is going to be successful to restore that sustainability. On the other hand, the IMF provides financing when many other creditors are not providing or withdrawing credit from the sovereign. The IMF is a crisis lender. And we don't want holdout creditors to veto IMF lending. Indeed, the faster an economic program can be agreed with the debtor, the faster the member can implement needed economic reforms, and the better the economic outlook will be for the member and the system at large. Finally, an economic program with the IMF serves as a commitment device and is often a prerequisite for constructive creditor engagement in the debt restructuring. Therefore, the policies must not be too restrictive. The key issue is to find the right balance. What arrears are covered by these policies? Looking at this slide. First, only external creditors because of the focus of the POP in terms of residency. And second, the policies only apply when the member is seeking IMF resources. So how do we get the needed comfort that restructuring will be successful? It depends on the creditor type, given different creditor characteristics. The policies, or rather a single policy that we don't, or the fund does not tolerate arrears to external creditors when the debtor wants IMF financing, was first established in the 1970s. As the creditor landscape has evolved over the years, so also did IMF policies. As you can see on this slide, the IMF has the lending into arrears policy with respect to the private sector since 1989, focusing on the debtor-creditors engagement and the sharing of information. With respect to official bilateral creditors, the IMF has the lending into arrears policy since 2015. The non-toleration of arrears policy continues to apply with respect to international financial institutions and official bilateral creditors in cases in which no debt restructuring is needed under the IMF supported program. Keep in mind that when we are talking about the IMF's treatment of a claim under the arrears policy, it's not necessarily determinative of the treatment of a claim get in the actual debt restructuring. This is for the debtor to decide. It may depend on a number of factors. Next slide, please. Now I would like to reiterate what conditions in particular need to be met in every case of an IMF supported program. First, debt needs to be sustainable on a forward-looking basis. This will incorporate an announced debt restructuring, reflected in this DSA, which sets the financing envelope necessary to restore that sustainability. Second, a fully financed program. In a typical program, creditor commitments and market access provide this financing. In restructuring cases, arrears can provide this financing. Last, adequate safeguards. Just because the IMF can lend under the arrears policy doesn't mean it should. In some cases, we may need additional safeguards. In the end, we need to be comfortable with the member's capacity to repay. The member also needs access to other financing sources, official or market, not only together with the IMF supported program, the famous IMF's catalytic role, but also by the time repayments to the IMF fall due. Thank you. Let me now hand over to my colleague, Tom Best, on the lending and arrears policy. Thank you.
Thanks, Wolfgang. So the first and most overdue part of this review is of the policy on lending into arrears to private creditors, or LIA. And the LIA policy is intended to deal with situations in which the debtor has defaulted on private creditors and needs to undertake a restructuring of those claims. The policy was originally introduced to remove veto power from private creditors who could previously block a fund program whenever there were arrears. So the LIA policy provides a framework for the fund to support members that are running arrears, as long as they're taking appropriate steps to resolve them. In these arrears contexts, the fund needs to have confidence that a private sector restructuring will ultimately be successful, so that the member can be restored to external viability and regain access to international markets. So how does the LIA policy help us get that comfort and maintain a delicate balance between debtors and creditors? Well, the existing policy summarized on this slide looks largely at process aspects of the restructuring discussions, focusing on debtor actions towards a restructuring, summarized by the requirement that they should be making a good faith effort to reach agreement. And the key point to emphasize under the existing policy and that's carried forward is that the assessment of good faith is a judgment informed by several factors summarized in the bullets. No one of these factors is required or determinative, and we need to take into account the specifics of each case and where we are in the process. The other point to mention is that the policy makes reference to entering a formal negotiating framework with creditors committees, where a representative committee is formed on a timely basis and where merited by the complexity of the case. So we move to the next slide. In terms of the results of the review, the bottom line is that the new policy doesn't make major changes, but it clarifies some factors and streamlines. There are more details in the paper we published last week, but the key points are: first, on creditors committees, the new policy calls on the debtor to engage with them where they're representative, which again is a case-specific judgment, but it drops some unnecessary complications that weren't really used in practice. For example, the reference to the complexity of the case and this formal negotiating framework. The second change is on information sharing. And the adjusted policy now refers to sharing all relevant information with creditors, where the old policy focused on non-confidential information except in creditors committee contexts. The change recognizes that while there may be restrictions on market sensitive info, this is something that the parties can usually figure out what works best, for example, through non-disclosure agreements. The second point on information sharing is that the new policy makes explicit the expectation that a debtor should share a comprehensive picture of the debt stock, where this disclosure should generally follow what's required under other fund policies, notably the recently revised debt limits policy. And finally, the new policy has one new factor, which is that the debtor's offer should be in line with the parameters of the fund-supported program. This is a bit different from the others in that it's about the financial terms of the offer rather than just the process. And it recognizes that part of good faith is that the quantum of relief proposed needs to be appropriate in light of the debtor's circumstances. We're bearing in mind that too little relief is not going to be sufficient to restore sustainability, and too much could jeopardize participation in the eventual restructuring. That's an element that was already included in the definition of good faith for the official arrears policy. So it seems natural to bring it into the LIA policy for private creditors as well. So the LIA policy is one part of the framework for private debt restructuring, but it only applies when the debtor has already defaulted and started running arrears. So the next part of the review covered so-called preemptive restructurings, i.e. those that occur before the debtor has missed a payment. These situations are slightly different, but the fund still needs to have confidence that a program is fully financed. We don't have the fallback that the member can continue running arrears to finance the program. The other key point is that in these contexts, time is of the essence, which means there are costs to having a policy that's too prescriptive on what needs to be done. So how do we get the needed comfort that a private sector restructuring will be successful when there aren't arrears? And as you see on this slide, well, there wasn't a formal policy for these situations in the past. A practice has developed of looking into whether a credible process is underway and is likely to deliver an outcome in line with the IMF program parameters. And that requires the fund to determine that there's likely to be sufficient creditor participation in the eventual restructuring. In terms of the review on the next slide, the main outcome is that this existing practice has now been codified into a policy. That shouldn't affect its application in practice, but we think it hopefully clarifies the expectations for both debtors and creditors. As I said, it's still a judgment call, this credible process, but some of the key factors are enumerated, including the debtor's engagement of advisors, whether they've launched consultation with creditors, and the details of the design of their restructuring strategy. And there's also a new consideration that's been explicitly recognized, which is that relevant information should be shared with creditors. That harmonizes with the LIA policy I just discussed, and it reflects the observation that timely information sharing tends to be helpful for the success of restructurings in this context as well. With that, let me hand over to Julianne.
Thank you, Tom. So I'll talk about the lending into official bilateral arrears policy. So how do we get the needed comfort that a restructuring of official bilateral creditor claims will be successful? So here we have a distinction that we do not have in the private sector context between restructuring cases and cases where arrears arise outside of a needed restructuring. For example, maybe a technical glitch. So in the non-restructuring cases, which in fund parlance refer to non-OSI or non-official sector involvement cases, we require that the arrears either be cleared up front or the creditor can object to fund financing at the board meeting. Now, prior to 2015, this same non-objection clearance policy applied in the restructuring context. However, as Lee described at the beginning, the fund adopted the lending into official arrears policy at that point to allow the fund to lend into carefully circumscribed circumstances in the face of holdout bilateral creditors. There we get assurances that the restructuring will be successful in other ways. First, we look to the Paris Club process. And if the Paris Club has reached an agreement and they're in the majority, we can rely on comparability of treatment to deem away the rest. However, increasingly, the Paris Club is not in the majority. So we move on to seeking creditor consent. And if we don't have consent, we look at the 3 criteria under the lending into official arrears policies. In particular, that the debtor is seeking good faith efforts to reach agreement, and there's no negative impact on the fund's ability to catalyze financing in the future. Now, this policy was adopted quite recently, so there were no changes proposed during the review. However, there were 2 points of clarification. First, where a claim is considered to be related to a restructuring, that determination carries through to successive arrangements, even if the arrears aren't cleared. We don't want to incentivize any kind of wait and see behavior on the part of creditors. who might be hoping for eventually improved economic conditions that would allow a full payout. The second development since the policy was established was the emergence of the common framework. The fund is very supportive of the common framework, but we don't yet have sufficient experience with the process that the common framework will deliver the necessary assurances. So where the Paris Club Secretariat is participating, we can rely on existing practices, but the common framework on its own hasn't been recognized yet as a new standing representative forum, but staff is going to continue to monitor this. Now, the next part of the review was about international financial institutions. And how do we get the comfort there that a needed restructuring is going to restore debt sustainability successfully? Now, this is a bit of a trick question because historically IFIs have not been restructured. So de facto, we've generally required clearance in full, either upfront or over the course of the program period. And this was known as the non-toleration policy. However, there were a couple of big drawbacks to this policy. First, the policy was set up to give this non-toleration treatment only to IFI creditors that were considered multilateral creditors in the fund's judgment. And that judgment took into account factors like the IFI's membership, whether it was global, how the IFI had been treated in the past in restructurings in the Paris Club and under the HIPC initiatives. However, for IFIs that were not considered multilateral creditors, we actually didn't have a policy on how to treat arrears. So de facto, every IFI was a multilateral creditor. Relatedly, IFIs are now proliferating, and many are relatively small with a specialized focus. And the creditor community as a whole does not necessarily want all of these small IFIs to receive preferred creditor status and be excluded from the scope of restructurings. So the fund also needs to take that into account in its policies. And finally, extending the non-toleration policy to all IFIs actually dilutes the value of that protection. So we need to be able to differentiate among IFIs. So in the review, we introduced the same restructuring, non-restructuring distinction as we have under the official arrears policy. So for non-restructuring or non-OSI cases, we still require a credible plan for the clearance of arrears over the program period. But in restructuring cases, the decision on whether an IFI will get this non-toleration treatment continues to be judgment-based. We continue to have the same factors under consideration that we did before with two additions, which are numbers 2 and 5 on this slide. Number 2 considers whether the institution is a regional financing arrangement or a reserve currency union central bank. Those institutions have a role of supporting the global financial safety net, similar to what the fund does. And under point 5, we consider the treatment of the institution by an official creditor committee in the case at hand, namely whether the IFI is expected to give comparable treatment or not. So for IFIs that meet the criteria for treatment under the non-toleration policy, they will continue to have that treatment. And we've introduced a policy on how to treat those that don't meet those criteria, finally, and that will be the lending into official arrears policy, which is the same that bilateral creditors get. So just to summarize in visual format, we first consider whether the creditor is an IFI. The World Bank gets special treatment under the concordat that we have with them. So we always require an agreed plan to clear arrears to the World Bank. And then we have the OSI, non-OSI distinction and the judgment as to whether the IFI should be considered covered under the non-toleration policy. So with that, I'm going to hand it over to my colleague Thor for some discussion on the perimeter.
Thank you, Julian. So as Wolfgang mentioned in the introduction, we are facing a more complicated creditor landscape. If we can move to the next slide, please. So, and therefore we are a part of the work was defining the perimeter between official and private claims. Sometimes it's not clear which of these buckets the claim will fall into. It can involve an export credit company conducting transactions for the government on concessional terms and under a statutory mandate, transactions with the private sector on market terms, and we needed to know, what level of comfort to seek regarding the likelihood that claims will be restructured. So there we have the definition on what constitutes an official claim, when it's either held by government or an agency acting on its behalf. and it originates from an underlying transaction where the creditor government or an agency acting on its behalf provided or guaranteed financing to the borrowing country. And in that regard, the review clarified a couple of practices that already existed. So the claim is considered official if it's extended by or on behalf of the government. And the government in this context means an entity within the budgetary process of the creditor. Similarly, when we're talking about sovereign arrears, we are talking about a claim owed by an entity within the budgetary process of the debtor. So the budgetary process is an important delineation. And so when a claim is extended by the government, when is that considered? We look at the totality of the circumstances. We start with the representation of the creditor, and we can also take into account things like financing terms, entity mandate, public announcements, etc. So the totality of the circumstances. And finally, where official bilateral creditors buy claims on the secondary market, for example, bonds, they could be subject to the same standard as private bondholders. So they're not extending financing directly to the sovereign debtor in their purchases, but identical instruments are usually restructured as a group. If we can move to the next slide, please. So on defining the perimeter between official and private claims, also there were 2 amendments made. So where claims are both pooled with private creditors, all the claims will fall under the lending into arrears policy. And this avoids complicating the restructuring. If we give preferential treatment, for example, a veto over fund financing to some holders of a bond, while other holders don't get that, the restructuring could get held up as official creditors forum shop and private creditors ride on their coattails. And secondly, some IFIs, in particular regional financing arrangements, provide balance of payment support through secondary market purchases. And such purchases actually merit the same protection under fund policies as direct lending by that IFI. And this means, in fact, that if the non-toleration policy is applied to direct lending, it should also be applied to such purchases. That said, if the IFI indicates that it wants its claims to be treated pari passu with the private sector, we would not second guess that and would apply the lending into arrears policy. And this could include, for example, public sector purchase program, the pandemic emergency purchase program in the euro area by the ECB, unless the ECB actually changes its mind. So all this is summarized in this flowchart. Let me quickly walk you through it. So the first level, as I mentioned, it's defining the official ownership. The second is sort of checking whether the claim is part of a pooling voting mechanism or not. And then further nuancing is the origination of the claim, whether it came through a primary market purchase or a secondary market purchase. So, for example, there may be secondary market purchases that have been aimed at stabilizing bond markets, and those should be treated pari passu with private claims, because the claim otherwise could de facto subordinate existing private bondholders. So with that, our presentation is concluded, and let me now hand over to Rosa Lastra for the commentary. Rosa, over to you.
Thank you very much. So I'm Professor Rosa Lastra. I'm the Sir John Lubbock Chair in Banking Law at the Centre for Commercial Law Studies of Queen Mary University of London. And I would like to start this paper commentary by thanking the IMF Legal Department for inviting the Sovereign Debt Forum and the Institute of International Economic Law of Georgetown to co-host this event today, and also by saying a few words about the Sovereign Debt Forum. It was established in 2019. It's actually the brainchild of Lee Buchheit, and it's a collaboration between Georgetown Law Institute of International Economic Law and the Centre for Commercial Law Studies of Queen Mary University of London. And we also work with the scholars at leading academic institutions in Africa, Europe, North and South America. The SDF, or the forum, serves as a policy-focused, interdisciplinary research hub and also a platform for capacity building and research dissemination programs. And our capacity building focuses on low and middle income countries which are at risk of sovereign debt distress, as well as countries that have recently gained market access and have limited debt management experience. The academic directors of the forum are Anna Gelpen of Georgetown, who will be speaking shortly, and myself, Rosa Lastra of Queen Mary. And the other founding directors are Lee Buchheit, who has just spoken and will speak again in a few minutes, Mito Gulati and Sean Hagan, who will also speak. So I will now invite my colleagues to comment on this newly revised review of the IMF sovereign arrear policies and the perimeter between official and private claims, which has been presented by IMF staff, with thanks to them, Wolfgang, Tom, Julian, and Tor. And first I will give the word to Carola Moreno, who is the Director of Finance and International Affairs of the Ministry of Finance of Chile, and who has been invited by the Sovereign Debt Forum and the IMF Legal Department today to make 5-minute comment on the newly released review. So I will now mute myself and I'll keep the camera on and give the word to Carola. Thank you, Carola.
Hello, good morning, good afternoon, everyone. Thank you, Rosa. Thank you for the invitation of Georgetown. As it was said kindly by Rosa, I am the Director of Financial and International Affairs at the Ministry of Finance. My remarks will be more on the economic side. This is a very timely review. Experience should be considered after reasonable time has passed, as has been done before. And this was a very timely occasion to do this. We know the pandemic left scars which have not been healed yet. Poverty increased, inequality was deepened, making more visible also that women and younger population have less opportunities. But of course, the discussion here has to do with more vulnerability as fiscal deficit significantly increased, and of course, debt levels are at historic heights. So we know the fund and other multilaterals activated emerging lending at unprecedented scales, but recovery lags in some regions. Debt service and fiscal consolidation more generally, which, I mean, we know in normal times require careful implementation of some policies, but they have become more challenging to implement. So I'm coming from a very diverse region, so my comments will be centered basically on 3 elements. Regretfully, one of these concepts has been repeatedly mentioned in a lot, and it's a very negative concept, but the other 2 are very positive. So I will concentrate on vulnerability, transparency, and good faith. So on the side of, as I said, vulnerability, so it's the recurrently mentioned word that we wouldn't like to hear so often. We've had financial crisis, bank balance of payment, currency crisis, and more recently, this sanitary driven crisis. Preemptive debt restructuring, therefore, as a practice for members not yet in arrears, is now codified in formal coding policy, informal policy. And this is very good news to address this vulnerability that I'm mentioning. It gives higher flexibility in applying LIA and making it closer to LIOA. So we have here a revision that allows for more, we could say, preventive restructuring, giving more credit also, allowing for more credibility, sorry, repeating the concept, on restructuring programs already also in place. So the second concept I want to emphasize is transparency, and I cannot underscore the importance of this. So this is really good news that we have explicit mentions and emphasis in the revisions. So debt management does not only require good policies. We need credible and available data to not only implement the policies, but also to transmit to creditors what is going on and what is the more actual situation that they're facing. And so also something that it's emphasized in the revision is more accurate information sharing. And there's an expectation that this is also enhanced in time. And so again, this will underscore the importance of transparency. And a very important element also embedded here is it's building trust, which is also key. So the third concept in which I wanted to frame the revisions is good faith. Because, I mean, transparency at the end of the day leads to good faith. And it's an element that it's included right now. And both debtors and creditors should make their best efforts to in these lines. It should also, on this good faith point of view, be underscored that creditors' expectation should consider legal and operational impediments. There are also issues of market sensitivity. So all of this should be considered when more disclosure is asked from debtors, and how creditors will align with the expectations of the data delivery. Another comment in this regard is that overall, the question on how to assess this criteria remains an issue for further consideration, not completely defined. So in closing, some remarks, fiscal vulnerabilities and risks of balance of payment crisis are better addressed with this revision. This is positive news for debtors and creditors. Incentives for increased transparency, including expectations, as I was just saying, of improved information sharing, are very valuable. But yet, we need to define what constitutes relevant information. I want to highlight how this revision promotes constructive engagement between debtor and creditor. And one of the many consequences is increased credibility of the restructuring of a member country. So here we have more consistency with parameters of fund-supported programs. Last and not least, it's always mentioned, but as a region, would be interested in knowing how IFIs with regional membership will be treated, as it is not yet defined. There is no guidance, and it would be very valuable to have a further discussion. So thank you very much.
Thank you very much for those comments, Carola. And I will now give the word to my co-director of the Sovereign Debt Forum, and dear friend Anna Gelpen, who is the Anne Fleming Research Fellow, Professor of Law at Georgetown University, as well as non-resident senior fellow at the Peterson Institute for International Economics. Anna is joining us today from Florence, where she's also running in truly multitasking form the DebtCon conference. So Anna, the floor is yours for 5 minutes to make some comments. Thank you very much.
Rosa, thank you so much, and thank you to everyone, especially fund staff and my Sovereign Debt Forum colleagues, as well as the folks who have kindly agreed to comment on this very important paper. I want to start also by flagging the fact, as Rosa said, this is happening in conjunction with our flagship interdisciplinary event, which is sort of the festive Coachella that we call DebtCon in its fifth cycle. And it is a wonderful coincidence because like this panel and like this conversation, it is thoroughly interdisciplinary and brings together both research and policy insights, we hope, to help solve real world problems. There are three things that I wanted to flag, and the first is really by way of thoroughly praising fund staff and the fund more broadly for revisiting these policies and really working so hard to update them. This is a supremely important policy, which you wouldn't know from the way, from the title, right? So with all due respect, lending into arrears is gobbledygook to most of the world. But really, it is the one and only hard public law element of the sovereign debt crisis resolution framework that we have now. And I think it's something that we need to think about very hard. In particular, consider the two flowcharts, one that Julianne showed and another that Thor showed us. They're already really complicated. And I suspect they're going to get a lot more complicated and in a rather short period of time. So not only are things changing rapidly in the world of international capital flows, but also the pace of change is accelerating. And with that in mind, I think we really have to rethink the way in which this incentive framework and the broader context in which it operates is communicated to the world. I'm not holding out high hopes for change in the name, but we really, it's really financing debt crisis resolution is what we're talking about. It's financing a debt restructuring as necessary. And I do think that this is not just a presentation point. I think presentation is substance in this case. So second, also relating to the pace of change, I was delighted to see, in the spirit of sovereign debt nerdiness, starting with paragraph 13 of the paper and Thor's discussion of the perimeter, the complexity of this space being acknowledged and the need to have an all-in approach to the perimeter question. I think it is vital. I think that taking both the nature of the creditor and the nature of the instrument into account is absolutely the right way to go. One reason it's vital is that in a world where you have two different policies, however minor the difference is for official and private creditors, there is an incentive, there's an arbitrage incentive, right? And in a world where increasingly we see hybrid creditors and hybrid instruments, and I suspect we're going to see even more, the presence of two different policies could become an issue. I do wonder whether the specific exclusion, I guess, of public creditors holding instruments that are pooled with those held by private creditors is under-inclusive. I mean, there are lots of hybrid creditors and official creditors that hold private-looking contracts claims on the sovereign, and I do think that it's important to mind that fuzzy boundary. I guess my prediction is that we're sort of en route to some equivalent of the Evian terms in the Paris Club, where everything becomes case by case. And I expect the two policies to merge, but it may be a long process, and maybe that's fine. And finally, the role of the IMF is also changing in this world. So the IMF, still calls the shots in many crisis management situations, but its role both as a source of financing and as a policy setting framework is evolving and will continue to evolve. And there will be other processes and other institutions on the scene. And considering how these kinds of policies could work in a more, in a setting that has more institutions, different institutions that together make up the center of gravity, I think is something that's worth considering. But again, bravo, this is complicated, and really just congrats on trying and good luck on continuing. Thank you very much.
Thank you very much, Anna, for those comments. And now I will give the floor to Ben Heller, who has kindly agreed to also speak in our event today. And Ben Heller is Portfolio Manager at HBK Capital Management. So Ben, the floor is yours for 5 minutes with thanks for being here today.
Thanks a lot for having me. I guess I'm here to give a little bit of the private sector perspective. I want to reiterate that I think this is very timely. It's good to see the policy revisited, even if the part vis-a-vis the private sector hasn't changed that much. We've had significant experience in restructuring since the last iteration, and also I think some very significant changes in the state of play of bond documentation since the last time. So it's good to revisit it, even if there aren't big changes. And obviously we're going to have a lot of restructuring, so good from that perspective as well. I think the most important thing, for creditors is this question of like how we have to be engaged under this under the policy. So I wanted to talk, about that a little bit. One thing that I think is really good in the policy here is the emphasis on transparency, because that has been a real problem. And lately, I think the private sector, views it as of paramount importance. Experience that we've had in Mozambique is a good example, and Suriname, Zambia, lesser extent Ecuador, all of those, there were some surprises in terms of debt that showed up, and some difficulty in really getting a full understanding of the whole debt stack. And so I hope that transparency, when it's operationalized, is construed in a way that some of these cases would fail that standard. But I think the other thing that's important of putting transparency at the top is that it's something that it's kind of unilateral and fully within control of the debtor to do. Unlike some of the other aspects of engagement, which I'll get to, where it's like a tango, there are two sides to it, and often one of them is Argentine. So I think the question of this question of engagement, kind of moving away from the emphasis on creditor committees as the metric of engagement, I think is probably helpful. It's a vexed, this idea of committees is a vexed subject, and the paper goes into a lot of detail about why that is, and I think the assessment is correct. But I do think that among many creditors, there's still a desire to have encouragement of engagement through a creditor, through some kind of a creditor committee structure. And I think one thing to look at going forward maybe is to look at ways beyond the lending into arrears policy to create incentives for engagement. And I know, as I mentioned before, there's been a lot of reform in contracts since the last time LIA was visited. That we could maybe create incentives in the contract rather than using LIA to make this a requirement. And perhaps not hardwiring into contracts that you have to have a committee, but to wire into the contracts, if there's going to be a committee, how it might work, so that we don't have this issue that we've run into that the paper refers to, where you have multiple committees and you don't know who they represent, you don't know if they're for real. And so perhaps there's a way to take a little bit of this out of lending into arrears and get it into the contracts where there are incentives, maybe a lower voting threshold for a deal that's endorsed by a committee, and that committee is constituted in a way that's set out in the contract, so there can be an actual assurance that it's people who own bonds, that there's a voting process for that committee to be constituted, and we can get around some of these problems that the paper mentions about not knowing whether you're dealing with a committee that's for real or not for real. I think another thing that's important to note, and probably for people here, it's obvious, but for the in the private sector credit world, it's not obvious. And I think the box in the paper on Argentina gets to this. Sometimes the private sector has regarded lending into arrears as a cudgel for its use. And I think when that happens, that's a big mistake. It leads to accidents. It should be obvious to everybody on here that that's not how it's supposed to work. But it's good that we have that in revisiting the policy, it will reiterate to everybody again that that is not the way it is supposed to work. I do think, though, conversely, the private sector likewise isn't comfortable saying that they're going to give a veto to the IMF over deals it might reach with debtors. And that gets to the last point I want to make, this new substantive point about the debt restructuring being consistent with program parameters, which I know is part of the lending into official arrears policy. I know that some creditors' ears may perk up when they hear that and feel that it is almost like an attempt at SDRM from the back door. So I think any way that you can make it clear more precisely what that means, and that it is not an assertion of the power to dictate the terms of a restructuring to private creditors would be helpful. That's all I got.
Thank you very much, Ben, for that brief view on some observations from the private sector. And I will now give the word to, and I quite like when you talk about transparency as unilateral and the two sides of the tango, and one side of them almost always being Argentine. So that was a good one. I will now give the word to my colleague and friend, Sean Hagan, who is visiting professor of law at Georgetown University, and also for a very long time in general counsel of the International Monetary Fund, and someone that obviously has been involved both with the lending into arrears policy and then the lending into official arrears. So Sean, the floor is yours for 5 minutes. Thank you very much.
Thank you, Rosa, and thanks to the fund for inviting us to do this. I suspect that the staff must be really relieved to have this review behind them. As has been pointed out, it is a complex policy, but in my experience, the complexity arises not from the substantive policy analysis, but rather the task of getting any proposal through the executive board. And why is that? Because the governments represented at the board are also creditors and can be adversely affected by changes. And I think the papers reveal how challenging it has been for the staff to navigate this. So congratulations for having, crossed the line. A few specific observations and questions on the changes. First, on the policy on arrears for private creditors, which I think is the least controversial. The paper makes the important point about how arrears provide financing for programs. I would have gone a little bit further. I think that even where the debt is being restructured in a pre-default context, i.e. where there are no arrears, the very willingness of the fund to apply the LIA if necessary as a backstop provides the basis for financing assurances, which is the way it was applied, for example, in the context of the Ukraine. And I think this underscores the point that Anna has made about how this policy casts a very long shadow over the entire debt restructuring process. I completely support the elimination of the 2 tracks for creditor engagement that was established in 2002. When that was done, the assumption was that if there was a representative creditors committee, that they would push for formal negotiations through the sharing of confidential information, because that's what happens in the corporate context. But that never happened really in the sovereign context. Argentina refused to do it, but also interestingly, we found that creditors themselves did not want to do this because they would have to be restricted to be in compliance with securities law. So one of the questions that I have is having gotten rid of that distinction, really, at least my sense is that the operational significance of a committee being representative really is diminished. And I just wanted to, maybe I'm wrong on that. Also, I support the idea of applying the standard of creditor engagement to pre-default situations, but with one big caveat, which is that in a pre-default situation, you do not have time on your side. Your ability to pay under the original terms as pending an agreement is limited. And if you want to avoid arrears, there may be a need to be much more compressed in the creditor engagement. And this is something that Lee had always explained to me when he was doing that. And I assume that that's understood in the codification, but perhaps staff could confirm that. On the review of policy on arrears to official creditors, right now, that's in the spotlight, given the sense that there needs to be greater pressure on official bilateral creditors. There's no changes, which I think is understandable given the fact that it's a recent policy. But I do have a question. Although the policy is more restrictive, it doesn't give the IMF the same degree of leverage as under the LIA policy. It still does give the IMF an important tool. And my sense from the paper, and I might be wrong, is that the staff is somewhat pessimistic as to whether or not this policy is going to give significant leverage, including with respect to the third criteria. I think that would be unfortunate because I do think that the policy does have adequate flexibility, but I'd be grateful for staff's views. On the policy on arrears to international financial institutions, I can only imagine how sensitive this has been to negotiate, with every IFI wanting to be treated as multilateral. And the final outcome, which I know is not staff preference, I think reflects the reality of the situation. It will depend on a number of factors. In my view, the most important one is the attitude of other official bilateral creditors. Do they support exclusion of the institution from the restructuring or not? Because if it's excluded, they will be further diluted. And so I think that's the factor that will eventually dominate. And the final issue is the perimeter question, which quite frankly has been a bit of a nightmare, is one of the reasons why the policy was somewhat delayed. You know, what happens when an official institution buys sovereign debt on the secondary market? Is it private or public? The staff has been under a lot of pressure on this from official bilateral creditors, and I'm very glad that it held the line. And basically, as a general matter, these are not official claims. I have one question, which is the future treatment of the ECB. Although the ECB is treated as an IFI, the claims it purchases on the secondary market, I understand, will be subject to the LIA policy because of the vote pooling criteria. And I just wanted to, if staff could confirm that. But overall, I thought this was an excellent paper. And again, congratulations for the staff for finally having gotten this done. Thank you.
Thank you very much, Sean. And now we will have some reactions from the IMF panelists, as well as discussion among the speakers. And before I give the floor to the IMF panelists that presented the paper, I'm also going to introduce 3 additional IMF commentators that will now be joining the discussion as well as the Q&A. First is Marco Chamon, who is Deputy Division Chief of the Debt Policy Division of the Strategy and Policy Review Department of the IMF. Jan Liu, who is Deputy General Counsel of the Legal Department of the IMF, and Jeromine Settelmeyer, who is Deputy Director of Strategy, Policy and Review Department of the IMF. So who would like to take the floor first to address some of the issues that have been pointed out in the commentary that we just had? And I will now allow the various commentators from the IMF to let me know who would like to speak first. And if not, I will give the floor directly to Marco Chamon. I think the sound is not adequate. If you can try again.
The microphone. Can you hear me now?
Yeah, now we can hear you. So I will mute myself.
Okay, sorry about that. Thank you, my pleasure. I would like to start off with two of the questions that were asked, and then I can turn over to my other colleagues. There was a question about how we would classify the regional IFIs. That is indeed one of the issues that we struggled on the paper. We had the way that we envision the process is that we have the 5 factors that we will look at. That would be the regional membership, regional versus global membership, whether it is a regional financing arrangement, and how it has been treated in the past under HIPIC, by the Paris Club, and how it's being treated under the creditor committee in the case at hand. So historically, pretty much all the regional IFIs have benefited from this non-toleration policy. And I think going forward to change the treatment will take some departure. So in practice, that might take an official creditor committee insisting that some of the regional IFIs will need to be bailed in, and at which point we would then have to make an assessment in light of that information to decide how to proceed, given that there has been this change in sentiment among the official creditors regarding the treatment of that IFI. So we would take those 5 criteria into account, but taking the information of any recent development as indicated by the official creditors in the case at hand. There was another question from Ben on how the program parameters would factor in the offer under the LIA. And here, the fund is not supposed to micromanage the process. It's supposed to be a decision entirely by the debtor and his creditors of how to reach the agreement. But it may be useful to think of the arrears policy in relation to the other key debt policies that the fund has that need to be satisfied, which are debt sustainability and program financing. So if there is an offer that is not in line with the program parameters because it's too generous an offer on the part of the debtor, then we could run into a problem in establishing that sustainability has been restored on a forward-looking basis. Or maybe that very generous offer could create financing problems in the program. So that's why we are clarifying that the debtor's offer has to be consistent with the program's envelope. And on the flip side, if the debtor makes an offer that is too aggressive, that may undermine the prospects of the offer being accepted, which again can tie into the other policies, that can also be a problem as far as the fund policies go, because then we will not make the assessment that there's a credible process in train to reach that agreement. So either too generous an offer or too aggressive an offer can run into problems, not necessarily with not only on the arrears policy, but also on the other policies that the sustainability needs to be restored and that the program needs to be financed. I can turn over to my colleagues.
Thank you very much, Marcos. And now, Jeremy, if you would like to say a few words in response to some of the queries and also some observations on your own on these very important review policies that the IMF has just put forth. The floor is yours, Jeremy.
Thank you. So I'm not sure there were actually questions directed at me that were left open, but what I would maybe want to emphasize is that in the area of the policy towards multilaterals, indeed, what we are trying to do here is to have a more focused application that prevents dilution of the policy, and that is, consistent with the objective to maintain lending and restructurings that become feasible or that remain feasible in light of the very large and increasing proportion of debt held by international financial institutions. And so as Sean has observed, this is a matter of difficult balance. And as far as the lending into official arrears policy is concerned, maybe just one observation. So the policy was not changed, mainly because it has worked well, but also because any change, I think, would have taken us beyond the political consensus that we have at the board. So when the policy was created, the main difficulty that the policy was meant to resolve was the possibility that an official holdout would prevent a program from going forward. And so the so-called 3 criteria that Sean has referred to were meant to do that. And those 3 criteria remain in the policy. In the meantime, however, the main difficulty that we face in restructurings involving the official creditors is not so much that we have one official creditor that wants to block the program by not giving us consent to lend into arrears, but rather that some official creditors do not want to commit to financing assurances, which we require in pre-arrears situations, but are quite happy to give us consent to lend into arrears. So from the perspective of the policy, these are situations that we can manage. And we have actually used the possibility of going forward on the basis of consent by official creditors in arrears, even when they did not give us previously financing assurances, to go forward in at least one case. And this was the case of Suriname recently. The difficulty with this approach is that we must not use it in a situation where consent does not necessarily imply a perspective that the official creditor that is providing the consent will actually provide a restructuring in the future. And so, if you like, this is the weak flank, the logical weak flank of the lending into official arrears policy. And to a lesser extent, the leap of faith that the arrears policies take in general. Like Lee said at the very beginning in his remarks, the purpose of the arrears policies is not only to encourage creditors to play by, debtors to play by the rules of contracts by making a good faith effort to renegotiate contracts when they're insolvent, and hence safeguard the basic principles of the financial architecture that made sovereign debt possible. But the purpose of the arrears policies is also to give reassurances to the fund that arrears situations will be resolved in a way that addresses the underlying sustainability problem and hence allows the fund to get repaid. And so the presumption is that if the conditions of the arrears policies are satisfied, the conditions for debt sustainability in a prospective sense, in a forward-looking sense, are also satisfied. If you have official lenders that give consent to lending into arrears, who have previously refused to provide restructuring assurances, then equating the satisfaction of the lending into arrears criteria with the prospect that indeed there will be a restructuring is questionable. And so basically we will in the future have to decide on a case-by-case basis whether we are sufficiently reassured that the lending into official arrears criteria provide us with this comfort, namely that sustainability will be taken care of or not. And this is sort of a complication that, in my view, but I would like to hear also Sean's views on that, was not really reflected at the time when the arrears policies are created. They cannot be solved. The complication, I don't think, can be solved by changing the arrears policies, by making it more restrictive. But basically, they invite some room for judgment about whether the fund should go ahead in such situations. And I suspect it will be quite challenging for us to exercise that judgment in future restructuring cases.
Thank you very much, Jeremy. Jan, if I can ask you now to say a few observations. You've obviously been working very hard with other people in the department and other departments on some of the issues that have been discussed so far, and any further response or observation of your own, that will be great. Thank you.
Thank you, Rosa. And also many thanks to all commentators for the excellent observations and also the views. Maybe I will start by echoing what Jeremy said. I think a couple of other colleagues also mentioned. I think it's really important to understand how really arrears policy works, in the context of fund operation. As we all know, the arrears policy is really centered, against the fund's mandate, of providing financing to help countries address BOP problems under adequate safeguards. So really many times, the combination of adjustment and fund financing would be enough to really help countries address the problems. But in the very rare circumstances, a country's debt sustainability problem cannot be addressed purely through the policy adjustment financing. That's where the debt restructuring comes in. And also this policy, it really works in tandem, with other policies. So it doesn't really operate in vacuum. So Jeremy just mentioned the debt sustainability policy, the market access policy, the financing assurances policy. So they really kind of work together to really ensure that, our financing is provided under safeguards and really helping countries resolve their problems, and we get paid on time. So just a couple of other points. One is on preemptive restructuring. I think Sean correctly mentioned in that circumstances, time is of essence, and all parties need to work together to avoid a default, which would be really detrimental to the countries and cause a lot of dislocation, economic dislocation. So in that context, we codify the practice, but the new policy still provides a lot of flexibility as to the modality for debtor and creditor engagement. So in other words, we do not prescribe the modality for how the debtor should engage with creditors. The only thing we added to our practice is really to promote that transparency, meaning the debtor should also share the relevant informations with a creditor. That leads me to the relevant information. I think Carola mentioned we should really have a bit more guidance on what type of relevant information we really should share, or the debtor should share, with creditors. Indeed, we have to strike a balance in terms of the country-specific cases, and also the type of information would truly be conducive, to the engagement, between the parties, so that they can really reach a collaborative and a speedy debt restructuring agreements. So under the good faith principle, we do provide certain examples. For instance, the debtor should explain the macroeconomic problems, the financial circumstances that would justify a debt restructuring. And the debtor should also give a broad outline of the economic program. And also it should give a comprehensive picture of the outstanding debt stock and the terms, and more importantly, the parameter of claims subject to the envisaged debt restructuring. And we recognize the market sensitivity of some of the information, we also recognize there may be certain legal constraints. For instance, there may be confidentiality clauses included in some of the debt instruments. So in that case, we did mention that, if you cannot provide more granular information, you could provide aggregate information. Again, the objective is really to inform, the debt negotiations so that, a speedy restructuring can be achieved. And I think I actually agree with Ben's comments on credit committee. I don't think LIA policy should mandate the establishment or the use of credit committees. And we should really leave this to the debtor and creditors to agree on. And I think the practice and debt restructuring cases have already shown that there are really not difficulties for the creditors to establish, or for the debtor to engage with those credit committees. Our policy is saying that to the extent such committees are established, their representative, and they form on a timely basis, we encourage the debtor to engage, with those creditor committee or committees. My last point is on Anna's point on the hybrid creditors and hybrid instruments. Indeed, one of the reasons we conducted this review is to really reflect, the changes or evolution in the creditor landscape. We definitely have seen a lot of creditors playing different roles, and also, the instruments also have evolved. So in that context, I think still we have to strike a balance between providing, a criteria on the one hand, and also give flexibility in order for us to really decide on a case-by-case basis, because they're all very different. One example for us is the bonds, right? So official creditors also invest in bonds for commercial reason, and also for maybe the BOP support. So we really have to look at those cases, taking into account really the totality of circumstances, and really make a judgment. We can't really sort of just have like a very narrowly defined criteria, and that will be very difficult to apply the evolving cases. So we will definitely, again, keep an eye on the practice under the current position, and reflect on it. And I'm sure we will need to review these policies, going forward. Let me just stop here. Thank you.
Thank you very much, Jan. And now I will give the floor to Sean, who was going to answer to Jeremy's question. Sean?
So yeah, Jeremy, I can respond to you in terms of what happened prior to the adoption of the policy, which is that before the LOIA policy was adopted, the way programs went forward was through consent, because that's the only option we had. We would get the consent from creditors. So when the policy was being designed, the question was, should we retain that as an option? And the decision was to retain it. And I completely agree with you that consent doesn't help the fund in terms of determining sustainability. Because even though you might consent to the arrears, you're not consenting to do a restructuring consistent with the program. But of course, this is where the 3 criteria come in, which is you can apply the 3 criteria, as we've discussed, even where there's no arrears, as a backstop. And so the question is, and this is the question that I have, for the paper, is there is space in the 3 criteria for it to apply even to big creditors. And the question is the fund willing to do that? Or do they basically just feel politically that that's going to be impossible? Because there is flexibility in a policy to do that, and it was heavily fought over. And I just hope that it's given a chance.
Jeremy or Wolfgang, you want to answer to Sean's question?
The only quick comeback is that we are not sure. I mean, it would depend on the nature of the creditor and the our perception of the creditor's role in financing future IMF programs, but more importantly, it may not come to that because these creditors are happy to provide consent. At least so far they have been, right? And the issue is mostly with other creditors, whether they are happy with the fund to go forward, even when those creditors have provided consent. Now, of course, they can stop the program at the board, right? In that sense, we also need their consent. But in order to, I think, get consensus around programs in which lend into arrears, into official arrears, and where the LIO criteria are satisfied based on consent, we will need to make a plausibility argument every time that sustainability is satisfied. In other words, that the prospect of large official creditors playing a successful holdout strategy is remote, and that argument is going to be very country specific, and it may be a narrow argument. I think we made the argument for Suriname. I think it worked for Suriname. It may not work in other cases.
Thank you very much. Anna, you have a question for the IMF presenters?
I think we should go to the public Q&A given the time.
Okay, so the public Q&A, Ana Maria Viterbo asked, where do sovereign bonds supposedly purchased by the IMF under its investment mandate, Fifth Amendment, fall? And would any of the IMF presenters like to answer this question?
Thanks, Rosa. I'm happy to respond to this. No, thanks, Anna, for this very good question. Basically, I think it would be an investment. Therefore, it would basically a private claim. So this is how we have treated this. It's really under the official or the IFI claim is really only if it's really part of the global financial safety net, then it would be basically be an official and IFI claim. Under the investment mandate, like in any investment, it would be basically a private claim. And maybe Anna's question was also quite interesting under the perimeter, how would a syndicated loan participation be treated? It depends a little bit on the specifics of the case, of course. If there's a vote pooling, then it would, of course, the private sector would be out. If there's no vote pooling, we would need to look at this. We have actually looked at this very carefully. In practice, quite frankly, these syndicated loans with official and private are very, very rare. So we have not found many cases of this. Thank you for the questions.
Thank you very much. I would actually now like to give the floor to Lee, who spoke at the beginning. Lee Buchheit and myself wrote a paper on lending into arrears back in 2007, well before the publication of the paper lending into official arrears. And Lee, you have some thoughts which we presented in the paper about good faith and consent. And perhaps in the light of the latest paper, you would like to offer some reflections?
Thank you, Rosa. My view has been for a long time that the IMF is on hazardous ground when it undertook to assess something as subjective as the good faith of a sovereign debtor when it's negotiating with its creditors, whether commercial or bilateral. And for a while, I feared that the fund might proceed down an ever-increasing, ever more complicated explanation of how they would divine the good faith in those negotiations. I see in this paper a retrenchment from that, and I applaud it. In my experience, when creditors are told no in a negotiation, they regard that as bad faith negotiation. Of course, it isn't. I think Ben put his finger on it, and Sean as well. If a creditor, if a debtor is offering a resolution that is consistent with the parameters of the fund program, I cannot see how that can be bad faith. If the debtor is offering more generous treatment, it places at peril its IMF program. If less generous than the program would contemplate, then I can see that as a demonstration of bad faith. But inherently, good faith is a subjective determination. The fund is not, I think, going to be well placed going forward to be able to divine it in every circumstance. I'll stop there, Rosa.
Thank you very much. Before I give back the floor to the IMF to have some concluding observations and perhaps also answer Ben Snyder, Ben, would you like to say something else?
Oh, no, I don't think so. I think it's all been covered. I mean, I do think, you know, that I agree with Lee. The idea of good faith, it's too fuzzy. I think an emphasis on things that are within the control of the debtor is important. Transparency is important. I think issues of engagement, of specifying how engagement works, that should be left to the contract. I think there's room to improve the contracts, by the way, but that's a different topic for probably a different presentation.
Thank you. And Carola, would you like to add something from the perspective of the region where you come?
Okay, thank you very much. I agree with what has been commented. I mean, I want to commend the fund, and of course, fine-tuning can be done. I mean, the contracts, I agree with my predecessor that the contracts can be improved. Guidance on what constitutes relevant information, market sensitivity, confidentiality, granular versus aggregate data. I think these are considerations that it would be really good to have, and how regional membership of EFIs will be treated. Thank you for the explanation, by the way, but also an analysis of what the cost of excluding them would be. Flexibility, I didn't mention that, but this will allow for very more timely solutions, which is also very welcomed. And a point that I wanted to make is how we can further analyze whether the weight on debtors might be larger than on creditors, and maybe this could affect this actual constructive engagement that we're trying to move forward. So thank you very much.
Very much. So now we are about to finish the event. There are actually more Q&A that have been written, and I don't think we have time to go through them. So I will now give the floor for some final reflections to Wolfgang, Tom, Julian, and Tor, and with this we will conclude the event. So Wolfgang, you first.
No, thanks so much, Rosa. Now, thanks to the panelists, to the SDF, to Georgetown, and to everybody for this very, very good discussion. I think it was really excellent. And also to get your feedback and also to see how this is being perceived, not only the private sector, the official sector, but also in the academia. And I think we have as I said at the outset, we have actually engaged with many of you in this process, which was extremely helpful to really understand it from the market side, from the official side, but also from the academia, how these policies are being looked at and said. So thank you very much for this very good engagement. I think I will stop here. Thank you.
Thank you very much. And then Tom, Giuliano, Tor, would you like to say some final word or reflection?
Nothing much further from me. I would just like to point out, in line with one of the questions in the Q&A, that the purpose of many of these changes is to incentivize early and efficient restructurings where they're needed. So hopefully encouraging more communication between debtor and creditor and information sharing will go towards that.
That was actually also in response to Ben Snyder, so thank you very much. And then finally, Tom and Tor, would you like to say a couple of final words before we conclude the event?
Very short from me. I really like this type of interaction. It's a very dense subject. We have been at it for a long time to get to this point, but I think we are sort of just starting, sort of breaching the starting the communication. And then, of course, like, there are resources on the IMF website. There are questions and answers who sort of try to explain this in sort of more plain speak and not the language our colleagues in the legal department like to communicate in. But and then, of course, the proof is in the pudding. It's going to be the application, and that's how these policies have evolved. So I'm very happy to be a part of that dialogue.
Thank you very much. And then, Tom, you have actually the final word. And this topic is going to be, as many have said already, very relevant, with rising public and private debt stocks and acute sovereign debt vulnerabilities around the world. This cannot be more timely. So, Tom, you have the final word.
Yeah, I don't have very much to add, but as you said, it's a very important topic. The application of these policies is going to continue to be key to resolving debt crises as they come up, which they're going to continue to do in the coming period. And this kind of interaction and feedback is always really useful to us. And there's also great food for thought here on how we can make sure that this stuff is communicated to the outside world in a way that everyone understands what's going on and can help us ultimately resolving these crises.
Okay, and so on behalf of the Sovereign Debt Forum and also the Institute of International Economic Law, very many thanks to the IMF for allowing us to co-host this event on such an important subject. So thank you very much to all, and goodbye for now.